Welcome everyone to today's webinar titled Life and Annuity Unanswered Tax Questions. I'm Linus Sugis. I'm Senior Consultant at Advanced Underwriting Consultants, and I'll be hosting your webinar today. Before we get started on Life and Annuity Unanswered Tax Questions, let me remind you that next month the webinar's title will be Secure Act Regulations Require RMDs First. We hold these webinars on the first Wednesday of every month at 11 o'clock Central. If you know of financial professionals or life insurance agents who you believe would find value in attending these webinars, they are welcome to join us. Feel welcome to contact us and we can put them on the invitation list. So next month's webinar will be Secure Act Regulations Require RMDs First, and then our June webinar will be titled Dealing with Do-It-Yourself Clients. That webinar will again be on the first Wednesday of the month, June 4th at 11 o'clock Central. Feel welcome to invite any professionals that you believe will find value in the webinar because it is free and open to them. Let's go ahead and get started with today's webinar. So, life and annuity unanswered tax questions. We're going to cover four questions that really don't have solid answers from the IRS or the courts or any source really. But we'll do our best to give you some guidance with regard to these four questions. The first question has to do with jointly owned annuity contracts. If we've got husband and wife that are the owner of an annuity contract, can we do a 1035 exchange of that annuity contract for a new one-owner contract in just one of the spouse's names? That's the first question that we'll ask and we'll answer to the best of our ability. The second question has to do with modified endowment contracts, and that is loans against modified endowment contracts are taxable to the extent of gain in the contract. Is it possible to stay ahead of the gain in the contract by paying loan interest along the way? That's another question that we'll tackle. We'll also deal with business valuation after the Connolly case. The question that has no answer yet is it possible to fix the value of a business for estate tax purposes, even when there is life insurance owned by the business? Can that life insurance death proceeds, can those be ignored when valuing the business for estate tax purposes? Is it possible to do that? And then the last question that we'll talk about is the relatively new 529 plan to Roth conversion ability. It's only available to those who have 529 plans that are 15 years old or longer. And then the question that we'll ask and potentially answer is, does a change in beneficiary start a new 15-year clock? So let's go ahead and get started. First of all, with can a jointly owned annuity be traded for a one-owner contract? This kind of question comes up all the time. Jennifer and I at Advanced Underwriting Consultants get questions about this. And the starting point is Code Section 1035, and Code Section 1035 certainly says that you can exchange one annuity for another. But the language in Code Section 1035, as well as in the rest of the tax code, implies that both the annuitant and the policy owner must be consistent before and after the exchange for the exchange to qualify for tax-free treatment. And what's the reason for that? Well, we think the logic is that the government, the federal government, is interested in making sure there is a deadline for ending the annuity. It wants to collect taxes eventually and doesn't want the deadline to be extended because that will defer the date at which taxes can be collected. And so making sure that owner and annuitant are the same both before and after the exchange go a long way toward that end. And if that were the only thing that we needed to consider, and many life insurance and annuity carriers stop there, only perfectly matching owner annuitant configurations would be possible to do a valid 1035 exchange. So if we've got a jointly owned husband and wife annuity, whether we have a single annuitant or joint annuitants, the configurations would need to be identical both before and after the exchange, most carriers believe, in order for there to be a valid 1035 exchange. However, if you look a little bit deeper into the tax code, you find section 1041, and it says this, and that is that no gain or loss is recognized on the transfer of property from an individual to a spouse. And when we do so let me back up. This is the code section that says that you can have a non-qualified annuity that is individually owned, and the owner can transfer the annuity to her or his spouse, and there would be no income tax result. Well, if we put together the requirements of Code Section 1035 with the logic that's contained in Code Section 1041, which allows transfers between spouses, if we put all of that logic together, it seems that we should be able to make an exchange, a tax-free exchange of a non-qualified annuity owned by two spouses, a jointly owned non-qualified annuity owned by two spouses, and we should be able to do a tax-free exchange of that into an annuity owned by just one of the spouses. Code Section 1035 combined with Code Section 1041 together implies that. Now, having said that, most carriers won't do it. They stop their analysis with the first part of just Code Section 1035. They don't consider Section 1041, and they only allow the exchange of joint contract for new joint contract. And that ends up being a barrier to 1035 exchanges in some cases. And the reason is that both the sending and the receiving carrier have to cooperate in the 1035 exchange in order for it to be a valid tax-free 1035 exchange. So we don't have a definite answer to this question. Logic says it should be possible. In our experience, carriers won't do it, and that's why it's an impasse, and that's why it's on this list of unanswered tax questions. Let's go ahead and move on to modified endowment contracts. So, situation where we've got loan interest on a modified endowment contract. If we have a MEC and if there are gains in the contract, if loan interest accrues against the policy, each time loan interest accrues against the policy, it appears to be another distribution that has tax consequences if there is gain in the contract. Now, the IRS hasn't said that, but it's our best guess. If we're letting a loan grow as part of a MEC policy, then the growth of the loan will be additional distributions subject to income tax. Now, some have maintained that if we have loan interest accruing against a MEC, but if it is paid in cash by the policy owner prior to the policy anniversary, then the loan interest shouldn't be treated as accruing against the policy, and therefore the loan interest should not be treated as an additional taxable distribution. There's some logic to that position. I'm not saying it's final logic, but there is some logic. The problem is there's no direct tax authority for that position. Most life contracts say loan interest accrues every month, and there's no administrative way for a client to pay loan interest prior to the time of its accrual. There's no way to match it up. At least most carriers don't have a way to match it up. And we believe that most companies are going to continue to report loan interest that accrues against the MEC as additional taxable distributions to the extent of gain in the contract. And there is no way to try to control that with loan interest payments on the client's behalf. That's not a final answer. It's not a for sure answer. It's an unanswered question, but that's our best guess. Third question is valuation of a business after Connolly. And so in the Connolly case, the Supreme Court implied that the death benefit of business-owned life insurance must be included in the value of a business for estate tax purposes. It didn't exactly say this, but a lot of people are worried that it is, in all cases, kind of analysis. We're not sure that that's true. Under the facts of Connolly, the parties had a buy-sell agreement, but the buy-sell agreement wasn't the kind of agreement that could fix the value of the business for estate tax purposes. The kind of buy-sell agreement that would fix the value of a business for estate tax purposes must pass this four-part test. Buy-sell agreement is a bona fide business agreement. It's not a device to transfer the business for less than it's worth. The arrangements has terms comparable to arm's length transactions, and the buyout price can be determined by the agreement. And the question is that if we've got a buy-sell arrangement, an entity purchase buy-sell arrangement funded with business-owned life insurance, and if this four-part test is met, will the life insurance, or can the life insurance value be ignored in coming up with a value for the business under Code Section 2703? And the answer is we don't know. We don't know for sure. The safe answer, I suppose, these days is to simply encourage all our folks who are worried about estate taxes, who have closely held businesses, to structure their buy-sell agreements as cross-purchase rather than entity purchase. That doesn't work for everyone, and so we may get a court case eventually that sorts this out. But we do not know for sure if it's still possible for redemption funding life insurance to be excluded from the value of the business for estate tax purposes. And then the last thing that we don't have an answer for is the 529 plan to Roth conversion. Secure Act 2.0 implemented a new rule, and that is that unused 529 plan funds can be converted to a Roth IRA, and the conversion would be tax-free. That's very good news. A lot of people have stopped with hearing that good news, and they don't realize the bad news is that the ability to do the conversion is really restricted. Here are the rules. First of all, the 529 plan must be open for at least 15 years. The lifetime limit for the tax-free rollover / conversion is $35,000 per beneficiary, so it's very limited. And in order to do the conversion / rollover, the Roth IRA must be in the name of the beneficiary of the 529 plan. Any recent contributions are ineligible to be moved, and the most you can convert / rollover in any year is $7,000, the current Roth IRA contribution limit. Getting to the $35,000 lifetime limit may take 5 years, may take more, may take more than that. And it must go plan to plan or trustee to trustee. You can't take a check from the 529 plan and indirectly roll it over into the Roth IRA. So what is it that is unknown? So many account owners would prefer, and we've gotten lots of calls on this, would prefer to convert the 529 plan account to their own Roth IRA instead of being forced to put the funds in a Roth account for the 529 plan beneficiary. So if I've got a 529 plan account that's been open for more than 15 years for my son, the rules say that I can certainly convert the 529 plan account, but it has to be rolled over into a Roth IRA, subject to the limits, that is owned by my son. Well, can't I just change the 529 plan beneficiary to myself? And the answer is partly yes, I can, but the question that gets raised by that is, well, do I have to start all over with the 15-year clock if I've changed the beneficiary to myself? And the answer is we don't know. We don't have any regulations on this yet. The IRS hasn't said so one way or the other. And so the only safe answer, I suppose, is a change in beneficiary would start a new 15-year clock unless the IRS tells us differently at some point in the future. And I guess I wouldn't hold my breath on waiting for IRS publications, particularly with what seems like the overhaul of the federal government with many people potentially being let go. We have the potential for a lot of these agencies, federal government agencies, to be short-staffed, and so the timing of publication of regulations may very well be longer in the near future. So what are the takeaways here? Well, first of all, what do you do when there's no final answer to a client's reasonable tax questions? I mean, that's the kind of situation that separates great professionals from really good ones in ambiguous situations. I think what you want to do is you want to explain to the client to the best of your ability the ambiguities. In cases where it's appropriate to pull in the client's CPA, sometimes perhaps the client's attorney, work together as a team to settle on the right way forward so that everybody is comfortable. So I'd like to thank you all again for joining us today, and I invite you to attend next month's webinars on RMDs first, and I'll look forward to talking with you then.